Hello, everyone. Thank you so much for joining us for today's free webinar on investor due diligence with Kevin Smith from Seed Change. I am Erica Malmsberg, and I'm the Chief Marketing Officer for Early Growth Financial Services, and I'm going to be your moderator today. This presentation is going to run about 45 minutes or so. If you have questions as we go along, please feel free to just jump right in and ask them. You can do so by entering them into the question field. You can also tweet them to us at earlygrowthfs with the hashtag due diligence. There is a way to raise your hand, but don't bother raising your hand. Just jump right in, entering those questions in the chat field, and we'll answer them as they come, or we'll also save some time at the end for an open Q&A. We'll also be providing our contact information at the end of the presentation, so you'll feel free to use that to reach out to us following today's webinar if any additional questions arise. And we'll be sending out a follow-up email tomorrow that's going to have a link to this deck as well as the recording, because we are recording today's session. Before I introduce Kevin, I just wanted to say a few quick words about Early Growth. We're an outsourced financial services firm that provides day-to-day accounting, CFO, tax, and valuation services and support for small to mid-sized companies. We currently have a footprint in 9 markets from Silicon Valley to New York City, and we currently support 10 to 15% of all venture-backed companies in the United States, with an impressive client list that includes companies such as TechShop, Indiegogo, Zendesk, Clout, RocketSpace, OpenERP, and over 500 plus more companies nationwide. So with that said, let's move on to our guest of honor today, Kevin Smith. Kevin is the co-founder and CEO of Seed Change. He's also the founder of The Vault, a startup co-working and incubation space in San Francisco. In his previous lives, he led the development of new iShares products and businesses around the world, including development and introduction of equity and fixed income ETFs and expansion of iShares to Mexico, Australia, Brazil, Chile, Peru, and Colombia. He also ran IPOs, acquisitions, and other transactions for tech companies in Silicon Valley at Davis, Polk & Wardwell. And he co-founded and led a business consulting firm in Moscow from startup phase to profitability as the largest consulting group in Eastern Europe. So good morning and welcome to you, Kevin.
Good morning, Erica.
So before we jump in with today's agenda, do you want to just first say a few words about Seed Change and maybe about the Vault as well?
Sure. Seed Change is really kind of the culmination of everything I did in my previous lives. I did a lot of work on various aspects of funding, and one of the things that occurred to me is that over the course of the last 10 years or so, the way early stage companies get funded and the way investors find, vet, analyze, and invest in early stage companies has really changed. And whereas 15 years ago there was kind of an established process, you compiled a really cool deck and walked up and down Sand Hill Road pitching to VCs. Nowadays it's not the way it works. And so we set out to create a process to take the things that work well in other types of asset class funding and bring them into the early stage market. Seed Change is an investment firm. We focus only on early stage companies. We've seen more than a couple of thousand companies in the last couple of years. We've worked so far with about 16 to get funding, and have about that many more in the pipeline right now. The Vault was another creation out of a need that we saw. We were looking for space for Seed Change, didn't like the office space that we found or could afford, and took a look at larger group kinds of spaces. Again, I thought that most of the co-working spaces out there weren't really right for early stage technology companies, and we could do it differently. So we did. And we opened in San Francisco about a year and a half ago, opening in Brooklyn later this year, and 8 other locations next year. So that takes us sort of to diligence, because that is one of the issues that I found really difficult. There's not a really established process for companies. Often companies get started the fundraising, you have some sense about what you're trying to do, how you're trying to do it, and then people start asking questions, and a lot of times I found the companies that were a little surprised, didn't know how to handle it, weren't prepared for the diligence process. On the other side, I found that investors also aren't often prepared for the diligence process. It was kind of interesting. After we launched Seed Change, we started with a closed beta, about 100 investors on the platform, almost all of them out of the asset management or investment banking or legal fields. People had been doing investing dealing with investing for, in some cases 10, 20, 30 years. And one of them called me up shortly after. We had 3 companies when we started who were still on the platform. This guy had been, and still was, a portfolio manager at Goldman Sachs, had been doing this for 20 years. I mean, his entire career was nothing but investing in companies. And he said, these are all really interesting companies, Kevin. I'm not quite sure what to do with them. How do we start? I guess they don't really have 5 years of audited financials, do they? And so we found that even people who've been spending their entire lives looking at companies didn't know really how to handle investing in early stage companies. And it is a surprising process if you haven't done it before. And even if you've done it before, it's probably going to have a few surprises, and they're not going to be very nice surprises. It's kind of the corporate equivalent of a proctology exam. And you're going to find that people are going to be digging in, asking questions, poking around in things. In some ways, your instinctive reaction is going to be, that's none of your damn business, and you can't say that. So let's move on and get into a little bit of the preparation for the diligence phase. The way this normally works is in the early stage process in particular, you'll figure out what amount of money you're looking to raise. You'll have some thoughts about what the terms ought to be. You may well have decided that you're going to do it using convertible notes or safes as opposed to doing a priced round. That's the way most early stage funding is done nowadays. In fact, almost all. And you'll start figuring out who you want to target as investors and start reaching out. Before you start reaching out, though, you ought to spend some time really buttoning up things internally. One of the things that has to happen before any investor will take a look at you, you've got to be a Delaware C Corp. Most investors aren't allowed to invest in any other kind of entity. It's certainly all institutional investors aren't, and it's kind of an easy thing to get to. But remove that speed bump before you start talking to people. You should be incorporated in Delaware as a C Corp. If you're not, if you're an LLC, if you're a different company, very difficult to reincorporate in Delaware. It's not very expensive. Think about and really go through your business model. You're going to have a lot of questions from investors about the business model, particularly if there's anything novel about it. People are going to want to dig in, figure out whether this business model really can work, project it out a few years to see how it's going to grow and develop. And you need to have not only put this down on paper, but thought through the assumptions in particular around how it's going to work. Financials, people do want to see financials. Yes, you're not going to have 5 years of audited financials as you might if you were a public company, or a company looking to go public, but you should have pretty clean financials from inception and reasonable projections for at least the next 18 months or so. And you will probably find that there may be some investors who are looking for 3 or 5 years of projections. That's almost always a sign of a naive investor, and to me a yellow flag about whether I really want to work with an investor like that. 5 years of projected financials at the early stage is kind of a nonsensical exercise. It is sensible to be looking a couple of years out, but people recognize typically that you get beyond that and it's almost always numbers that are just made up. You do need to have your cap table cleaned up. It's a thing that people are going to dig through. Cap tables are a pain in the butt to deal with. They're difficult. They're complicated. It's funny that, kind of funny that over the years, typically law firms have managed cap tables for early stage companies. And I always thought it was kind of odd because it really is a spreadsheet exercise when you have lawyers managing numbers and spreadsheets. But that is kind of annoying. Nowadays, meaning in the last couple of years, there are a fair number of pretty good companies online, cloud-based cap table management companies, really heavy security, make it a little bit easier to manage, but the cap table has got to be cleaned up and ready for digging around in. Employee agreements, if you have employee agreements, they should be tidied up. If you have partner agreements, make sure you finish them off. Customer agreements that are important to your business and to the development of business, close those out, and make sure you actually own the IP that is important to you.
Before we move on, Kevin, we have a couple of questions here. First of all, a question from me, just because I know that a lot of the folks that we talk to in the early stages have a lot of questions about projections. So could you say a few words about sort of bottom-up versus top-down financial projections and what investors hope to see and the difference between them?
That's a good question. Top-down means you take a look at the market, and let's just say we'll use ourselves as an example. You look at how many investors there are in the United States, probably accredited investors in the United States who invest in early stage companies or could invest in early stage companies. And the latest numbers from the IRS are something like 15 million people in the United States that qualify as accredited investors. So then you take that, and you might also look at the amount of investing in early stage companies done last year, and that number is something in the neighborhood of $25 billion in the United States. And you start with that, and then you go down and try to figure out how big a piece of that can you get, and how big a piece of the company, how do you project the revenue stream, assuming a certain percentage of the market. That's top down. In my mind, and I think in the minds of a lot of investors, there's a lot of BS that goes into that. It's sort of the thing we've always heard. It's like, hey, if we just got 1% of the Chinese market, I mean, we'll all be billionaires. Right? It's pretty likely to get investors' eyes rolling right off the bat.
Mm-hmm.
The other way, I think, a harder but a probably more realistic way is to go from the bottom up. So start with looking at my particular product, the people that I am about to target selling to, how much they're going to be purchasing, and how we can grow that. So you're starting, rather than looking at kind of pie in the sky, the total possibility, start with what is likely to be happening the day we launch the product, and go from there. How do we grow? How do we develop? How do we expand our market? How do we expand our market share?
Right.
So you'll be starting with much small. You'll be starting with zero, actually, about as small a number as you can get, and trying to build up from there. And it's probably got a lot more basis in fact in reality.
Right. Much more. I mean, you're right. It's more of an exercise, but it's more of a useful exercise in really understanding your business. And then we have a question here from Ish. He wants to know, how about a C Corp registered in Washington? So can you speak a little bit more to your insistence on the Delaware C Corp?
Yeah, don't do it. There's nothing inherently wrong with other states, well, some other states. And I don't know anything particularly bad about Washington, but the fact is that there's only one state in the country that has a really well-developed body of corporate law. It has its own independent corporate legal system, and so you will find, for instance, there's scarcely a single public company that is not registered in Delaware. You'll find that because investors assume that companies are registered in Delaware, almost everybody in the country, whether you're a lawyer or an investor in Nevada, Delaware, New York, or Idaho, you're still going to be pretty familiar with Delaware law. That's not the case for other states. So if I'm a Washington C Corp and I'm looking for investors who are not based in Washington at any point in my future, those investors are probably going to feel the need to engage a Washington lawyer just to make sure that everything is in order before putting in an additional cost, additional amount of time that's kind of pointless. And so investors, more likely than not, will balk at going through the process and just say, hey, if you want to talk more, you got to be a Delaware C Corp. Otherwise, I'm really confining my investment to companies that are.
Right. Okay. Great. Thank you.
And another small note, you will find it's not that uncommon that small law firms will incorporate in the state where the company is based. I practiced law in Silicon Valley for a while, and in the firm that I was in, partners often joked that incorporating a company in California was de facto malpractice because California corporate law is kind of a mess. And it's not surprising because there's really never been a coherent, focused attempt to develop a body of California as there has been in Delaware.
Right, right. Okay, so we've sort of said about how to lay the foundation so that you're prepared for the due diligence process from the get-go. But now let's jump into, the due diligence process begins. So what's that look like? How's that happen?
Yeah, so this is, gloves are off. This is the part where you kind of have to go through, from a corporate point of view, you're going to be strip searched and people are going to be doing a body cavity search, and it's going to feel really intrusive. It's going to take
You make it sound so delightful.
It's wonderful. It's a really difficult process for a company to go through.
Yeah, yeah.
And if you're not expecting it, truly, and I've probably been through more than, well, I don't know how many, thousands of diligence processes for investments ranging from $50,000 to $100 billion. And in every case, whether it was a giant corporation or a really small kind of mom and pop kind of company, you find that people are really trying to figure out, it's almost like a forensics kind of exam, and that's the way I always thought about it, the way I approached it. You're trying to find out what's wrong with this company. You're trying to find the skeletons, sometimes hidden, sometimes not. But the way I always thought about it is every company has got some flaws. Some are bigger than others. Every company has got big problems of some sort, and so you're trying to uncover them. And then once you've uncovered them, you can figure out how to handle them and whether they're big or problematic or not. But the goal really is to figure out the holes, the flaws, the problems. So you will generally find that a lot of people often like to visit the company. They like to. There's something you learn about seeing where people work. You will find that people want to spend a lot of time with the founding team and may want to of the company, particularly on the dev side. May well want to talk with the CTO or perhaps the product manager or even lead engineers. They will almost certainly talk to vendors if you have key vendors. Not people who are providing, not the folks at MailChimp or Google, but vendors that are providing key components of whatever product you have. We'll certainly want to talk to customers, particularly major customers, and here they're often trying to figure out, get a sense of what the buying decision was like, why customers decided to develop a relationship with your company and with your product, how they use this particular product, how they think it stacks up against the alternatives they had, what customer service has been like, how willing they have found the company to work with them as a client, as a customer, how they expect to continue using this product going forward. And then, this has become more important over the past couple of years as the SEC has added new regulations requiring background checks, or really increasing liability for investing in companies led by founders who have, let's say, problematic backgrounds. So you'll find that people will want to do background checks, and it ranges from everything from criminal background checks to often talking to references, talking to professors, former employers, and so on. So think about making sure that these people that you've got lined up a target list of people from all of these groups that are going to be willing. Potential investors, make sure you've kind of teed them up so that they are willing to do it, B, know what to expect, and tee them up so that they will hit the points that you want the investors to know about. For instance, we recently talked with a company with the very important partner of a company, and the company had teed them up in advance to focus on what was novel about this product and what the product roadmap looked like and why, and the partner was able to spend a lot of time talking very intelligently around what was novel about this particular product, in particular about where over the course of the next 6 months this product was really going to blow everyone else out of the water, why, how, what the timeline looked like, and how confident they were that they were going to be able to do that. It was a helpful discussion.
I know you're going to be talking more in a little bit about the due diligence process, like the schedule and the timeline, but just to clarify, we have a question here from Pri who wants to know, does due diligence actually begin after you receive a term sheet? Institutional funding, not accelerator, friends, family, smaller angels.
Not so much. Diligence is going to start early. I would think about it as the very first time you have a conversation with a potential investor, the diligence process is beginning, because that investor is already beginning to assess you. And I'll give you an example. A long time ago, well, not that long ago, a few years ago, we were applied for an accelerator, top-notch accelerator, really well known, very good professional process, and we were flabbergasted. In the third round, we had a kind of a panel Q&A. We walk into a room. I felt like I was in, being interrogated by the CIA. There were seven people on the panel across the table. We hadn't even sat down before they began firing questions at us, and we exited shaking our heads, trying to figure out what the hell just happened and why, because so many of the questions that they asked were really personal. They were questions like, what do you guys do together when you're not working? Do your significant others know each other? Do they like each other? What's the last time the four of you did something social? Where did you go? What did you do? If we were to ask your significant other what she thinks about your co-founder, questions like that, and we figured out that they were really trying to get at the founder team's relationships, the background of the founders, the personalities of the founders, and so that's why I say that right from the get-go, people are already beginning the diligence process. They're looking to assess you, assess your leadership skills, your sales skills, what it's going to be like to work with you, your integrity, and so on. From then, though, well before you get a term sheet, you should expect that the investor is going to be doing a little bit of digging behind the scenes, perhaps taking what was in your deck, doing some market research, some product research, perhaps talking to other people in that sector, and so on. So the diligence process begins right from the moment you first begin a conversation with an investor.
Great, thank you. And that kind of segues into if you could map out, I guess, more what we're starting from that, the beginning where the due diligence process has already begun once you start talking to them, and then through the more formal process, if you could just give some ideas of the timeline and what that looks like.
And so it used to be, in almost what feels like ancient history, it used to be that a diligence process or a funding round process at early stage took on average about 6 months. So from the time you start and begin conversations to the time you close your $1 million round, or it used to be more like 600,000 or so, that was about a 6 month process. It's really compressed over the last few months. This is probably the greatest time in a century to raise funding for early stage technology in Silicon Valley, or other tech hotspots, because there's so much capital looking for an inadequate supply of opportunities. And so there's become a lot more competition among investors to get into companies, and therefore, I sometimes see people who are willing to forego diligence, or looking to do it really fast and get through as quickly as they can. In many cases, something you didn't see as often 2, 3, 5, 10 years ago, you find that some investors are willing to just piggyback on the whatever diligence process another investor did. So you might find that somebody says, I'm assuming that since lead investor, who's the angel who's already committed $100,000, I'm assuming that pretty extensive diligence and reached, and whatever she must have done is going to be good enough for me. In other cases, you'll find that people say, hey, just whatever diligence materials you sent to the other investor, send the same stuff to me. So the process can be a little bit faster than it used to be. That's not always the case, and obviously, I think the farther along you get, the more likely you're still going to get people doing a pretty extensive diligence process. What that means, I'll tell you that when I was in the law firm, we had a kind of a standard form diligence request list. And it wasn't a list so much as a book. It was about 110 pages of annotated questions and requests for materials. And you would extract out of that, so you wouldn't be providing a 110-page request list to a startup, but it still gets to be a pretty long list. You will typically find people have, maybe 50 to 100 different types of documents that they're going to be looking for. So it's going to take the amount of time that a diligence process takes to get through. Typically depends on the company, how quickly you can provide the stuff that investors are asking for. And if you have prepared in advance, you can know most of what people are going to be asking for, prepare that so that you're able to provide it, rather than running home and spending the next 48 hours without sleep at your computer putting together next year's projected financials. If you've got all this in advance, it's going to go a lot faster. It typically will start with some conversations, as I said. May go from there to a pitch deck. Probably pretty early on, people will look to see financial projections, both as well as historicals. Next, you may want to get your hands on a lot of material about the market and the product. Some people will ask you for, others they'll be able to go off and do their own independent research on. From there, probably you'll get to a process of, it's more of a one-on-one process. The investor talk to consumers, suppliers, key partners, talk to people who are experts in the field, and gathering more personal information, and then probably reasonably late in the process, people will be going through all the key documents that really matter. So if you say you've just signed a giant agreement with Cisco, people want to see that agreement. They're going to read the agreement. They may have questions about the terms of the agreement, but got to verify that that agreement exists, that that agreement is buttoned up, that that agreement is, you would like to know a lot more about what the potential relationship with Cisco is and how Cisco views the relationship. And all that, as you can imagine, takes a lot of time. I expect that we spend more than 100 hours per company diligencing the company before we agree to work with them or to list them on SeedChange.
Sorry, I'm just trying to move to the next slide here. Having some trouble. What's, oh.
No worries.
No, we just lost it. Hold on.
It's okay. So let's get a little bit more granular. People, as I said, often investors are going to want to talk to people inside the company. So everybody in the company should be aware that you're about to embark on a fundraising process. And there are a couple of reasons for it. One, some of them may be approached, or some of them may be interviewed by potential investors. So they need to be prepared for that process. Two, you know, as a CEO, you're probably the one who's in charge of it. A lot of time founders say that, you know, about 1/3 or 1/2 of their time on an ongoing basis is devoted to the fundraising process. So people inside the company need to know why you're never around and what you're focused on so much, and understand what that process is going to look like. It's a little bit dicey too, though, because you can find that companies get really obsessed internally with how the fundraising process is going. So while you want people to be up to speed and to understand how this is going, what's going on, you don't want them to lose focus on what they're doing, managing the business, coding, developing customer relationships, whatever it is, and start sort of, you know, watching the ticker in a way. And it's something we saw a lot actually in the last boom. Companies went from sort of first round of funding to IPO on average in 18 months in about 2000. And there were so many stories of companies, you know, once they IPO'd, you'd walk in, you know, people did really dumb things like put their ticker and live quotes up in the lobby of the office. So then you'd find, you know, 100 employees gathered around watching the ticker move at different times of the day instead of doing what they really should have been doing. And so you don't want to risk that. So it's got you got to think carefully about how you're going to communicate around the process and success or delayed success as well. People are probably going to have a lot of questions about what does this mean? How does this work? A lot of people are going to find that you're going to find a lot of people have never been through a funding process internally and want to know what's going to happen. How long is this going to take? What happens if we don't get the funding? What happens if we don't get as much as we're hoping for? What happens if it takes 6 months or a year longer? So you're going to need to have good answers to questions that people are going to have, the concerns they're going to have. In a lot of ways, I think it's like parents talking about finances around the kitchen table with the kids. You probably want your kids to know something about the way household finances are managed. You probably don't want them to be worried about being able to pay your mortgage and pay your electric bill, and so you think carefully about what you communicate and how you communicate it. And then as part of the diligence and preparation process, you're going to want to make sure that everybody internally is pretty clear on the way the business operates, on what processes are, and how things are documented. So it's not really enough to have developed a a really detailed development plan and sales commission structure and target, granular analysis of your sales pipeline if the sales team doesn't actually know about that as well. So make sure that you guys are all on the same page. Once that starts, you've done all the preparation, you've kind of got your ducks in a row. You're going to find, as I said, that people are going to be spending some amount of time talking to company members. And sometimes you're going to want to do it in groups. Sometimes people are going to want to talk one-on-one, particularly if there's a key employee, like a really important CTO, the head of your enterprise sales team, or other people that are absolutely, sort of core members, vital to the possibility of success. You may find and shouldn't be offended by the fact that investors may want to spend a lot of time one-on-one with that person, understanding that person. Part of what they're trying to get an answer. Hey, if things go well, is this person going to stay around? And if things don't go so well over the next year or two, is this person going to be around? And then, also, is this the right person for this particular role? Is this the person that can lead the team into where we need to be going with product development, or into the enterprise sales space, or whatever that is. Also, this is a thing you may instinctively kind of shirk away from, but if there are any kinds of team issues at the moment, those need to be resolved. It may mean that and I've seen this happen a few times, including last week, it may mean that you decide that somebody needs to be fired before you start the process. This happened with a company last week. Some real conflict internally with a couple of salespeople. One not performing as well as necessary, which was really the source of the conflict. Believe me, that's going to come out in the diligence process, and it's going to be a negative in the way investors evaluate the company. They're going to figure it out, and you better take care of it now rather than later. If it's not going to be able to be resolved, and in some cases, you may find that you just need another person in the spot, and better to take care of it now. Product. Key, people are going to look at the product roadmap. Why? Why are you developing? What's the product? What does the roadmap look like? But more importantly, why? Where are you trying to take this? And you're certainly going to be talking to customers. If you got quality problems, if you got bugs, or more importantly, if your process for resolving quality problems is broken, fix it now. And that's going to be a key concern. People expect, software has issues. Hardware has issues. It's not that people expect it to be bulletproof, but really will expect that you've got a process for finding and resolving problems. Market. People are going to spend a lot of time talking about market. You'll find in general that investors looking to make an investment, particularly in the early stage, look at three things most of all: the product, the market, and the team. Some put more emphasis on one than another, but those are the key areas. And so it's important to have, if you've done your own analysis, you have your own research, your own data, that is different from what you expect investors to find, particularly if it's key to assumptions you're making about product development. You need to have that buttoned out and produced in a way that's easy, convincing, cogent for investors. Think through. Certainly, people are going to be thinking about competition, the right answer to an early question about how do you stack up against others in the area is that we don't really have any. The wrong answer is we don't really have any competition. There's always competition, whether it's another company or whether it's just another alternative way of accomplishing whatever your product is able to accomplish. But there's always competition. Perhaps status quo is the biggest competition, and so you need to have a very interesting and convincing answer backed up by how you stack up against competition and why whatever you've got has produced some reasonable barriers to entry by other companies. One way to think about it is, geez, if this is such a hot market and such an interesting opportunity, why isn't Google doing it? And if Google isn't doing it yet, but they see what is so interesting once you launch, what's going to stop them from throwing 100 people and $50 million into this and taking the market away from you? So those are sort of the basic elemental questions you've got to have answers to.
We have a question here from Michelle. It's kind of related to market analysis, more specifically to projections and what you were talking about earlier, but let's just jump in with that. She's saying, you said someone asking for 3 to 5 year projections is a yellow flag. I would agree, but to date, most people are still teaching this as mandatory. What would you recommend preparing? She's saying, we have a 2-year plan ready because this is what we're operating on. So do you think a 2-year plan, is that what you would recommend, or?
Well, here's the way I do it myself. When I've raised funding, I've prepared a 3-year plan. I've told investors right up front, we prepared a 3-year plan because, as you know, it's really difficult to project ahead, and your visibility getting out more than 2 or 3 years is almost zero. So there's no point in putting together numbers that we know are certainly going to change. And by introducing it, I've never had anybody push back. Just set it out right from the get-go that these are the assumptions that we've put together our projections based on. And we know, as you know, Madam Investor, that there's kind of no point in doing more than, looking more than 3 years out. And, just by making that assumption and making that assumption overt and, getting them to sort of agree with your point of view right away, you probably are going to be able to deflect the questions about it.
Yeah.
I do think, you'll find some investors who will recognize that even a year of anything more than a year is nothing more than an exercise, but we'll want you to go through the exercise and help think through the possibilities. We all know that the numbers are hopelessly optimistic, but we want to see how what it would take to get to a certain number. And you're really probably going to be looking a lot more into the assumptions. So you may say that you project 100 million in sales 3 years out. I know that's BS. But what I'm more interested in is, well, what would it take to get to 100 million? And then, sort of backing out realistically, what does it take to get to 10 million?
Right. I think that's exactly right. And, just to add my 2 cents, we do a lot of financial projections for our clients, and same thing, we do that 3-year plan because I think it's the rigor of the exercise and thinking through assumptions. And I think everyone understands that things can change, and that's why you have to do new projections. But it's still a worthy exercise.
Yeah, and I might say just a little bit around why one reason I consider it a yellow flag is that I just generally take that as a sign of a bit of naivete or unrealistic expectations. Mm-hmm. So it could be naivete because it's somebody who's used to investing in public companies or companies with a longer track record, or at least larger companies. It might be a private equity, but it's still a larger company that's been around and has the ability to kind of sensibly project ahead for several years. The other kind of investor, though, one not necessarily naive, although I guess you could argue that it's a different form of naivete, comes from investors, and frankly, and I do this often, but I'm going to diss on Midwestern investors again, because you see this pretty often, that that Midwestern investors in the Midwest are looking for 5 years of projected financials. They're looking, they interpret an early stage company as a company that's got, at least $1 million in revenue, and is going to be getting to at least 10 million in the next 2 or 3 years. A company that is got a valuation that is absurdly low, for which they're going to pay, give you they're going to expect an absurdly high amount of the company for an absurdly low investment amount. And so it's one reason that I can consider it a real yellow flag is it's often coming from somebody who is going to use financials as a way of beating you down on valuation. Next, almost always nowadays, unless you're looking at friends and family only, investors want to see some measurable traction, and people can define it in different ways, but it probably involves a user at some level or another. So it may not be a paying user. It might not even be a user if you're a hardware company, for instance, a user of a product that is already for sale. But you do need to find some evidence of some measure of traction. One way, for instance, that I found do pretty successfully is generating traction, as well as raising a little bit of funding and getting some user feedback, is to do something like a Kickstarter campaign. So it's a way, if you can show an investor, hey, in 30 days we got 100,000 people signed up. That is one metric that's useful for traction, even though you're not going to be selling your product or producing your product for another 9 months.
So I think this question you alluded. Oh, sorry. Can you see this? Moving on from traction, this question you alluded to earlier, that it can be pretty invasive, this due diligence process, and you may think it's none of your damn business when people ask you things. So is it in your right as a founder to say no to some things, or do you have to reveal everything, or where do you draw that line?
Well, that's a great question, and in fact, I think we even have a slide toward the end of it. I can't remember. Maybe we do, but we thought about it. Yes, I think there are times when you can say no, but you have to be careful about how you say no. It's got to be tactful, and you got to give a reason for, a rational reason for not providing it. So one example might be, might be 5 years of financials. You might get asked for it, and you probably, you're best off to say, well, we haven't prepared, we don't intend to prepare 5 years of financials, and here's why. And as I said, I've never had any real pushback on that. Another thing that people could ask for is details of IP. You may, depending on who you're talking to, not want to provide more than is publicly available because perhaps, I'll make this up, although this has happened pretty often, this investor was heavily involved in a company that is your key competitor. Other kinds of information, there could be really part of the process. I don't recommend just throwing everything at an investor early on. I give investors sort of piecemeal information, and I don't mean that to be sort of in a rude or an annoying way, but you don't need to give everybody absolutely everything until you've gotten more convinced that there is a very high likelihood of this investor actually putting money in. So The first person who says, yeah, this is interesting, send me your pitch deck, it doesn't mean you should also be sending the pitch deck and 5 years of financials and setting up interviews with team members and so on. You're going to do this gradually. You should be prepared for it. You should have the materials in advance, but you're going to provide things as investors ask for them. And in some cases, it may be too soon to provide the kind of things that an investor is asking for, or in other cases, it might be a thing that that an investor just probably doesn't need to have. If you have a specific example of something that you're concerned about, I can maybe talk a little bit in more detail.
I'll wait to see if there's a follow-up question, but not right now. Okay, cool. And then, I don't know, you probably don't want to go into great detail about this, Kevin, but you mentioned before, when you worked at the legal firm, how there's lists and lists of all the required documentation that people will need to submit as part of the due diligence process. And so we thought it'd be useful to all of you attending to give you an outline of what some of these things are that you should have prepared in advance. And again, you'll be getting this deck, so you can look through it in detail, but I'll let Kevin speak to it at a high level, but it's just kind of lists here.
Yeah, it's a list, and it's a decently long list, but it includes some things you might not otherwise think about, but that are important. It also is decent as a checklist for founder reality, and this is what I mean. We had an example a few years ago of a company, pretty interesting company, early stage, which is what we do. Not a lot of revenue, still working on, developing partner relationships and sales relationships. But one of the key pieces of the product relied on a relationship with a giant company. And they described this as, something, one of the sort of key selling points, something they were very excited about, something that the other company was very excited about. And we got decently far into the diligence process, and during an internal review, we discovered that our analyst team had not yet received a copy of the partnership agreement. Major failing on our part. But when we went to get the agreement, what we got was a redlined term sheet from 3 months earlier. We kept asking, digging, and what really turned out was the agreement wasn't done yet. In fact, they were waiting on comments from the other side to the first draft of the agreement. And although they ultimately did sign the agreement and the terms were as expected, this, as you can imagine, this really pushed back our timeline, even our desire to work with these guys. What I discovered was that this was symptomatic of what happens really frequently. Founders tell you things that aren't necessarily true. And I don't think it's usually because founders are misleading you. It's because they're already a few steps ahead. Reality in their minds is already, 3 months down the road. So that agreement, well, we haven't actually signed it, but in my mind, it's already done. It's a done deal. I've already moved ahead, and we're thinking about the next one. Or the product, doesn't actually do this. We're still in, we're still coding like crazy, but in my mind, we're already there. And you find that, again, it's not a conscious deception, I think, in almost all instances. It's just that founders tending to be hyper optimistic, very, in many cases, creative. In their mind, things have already happened that haven't quite gotten to. So this is what I mean by this list is also kind of a founder reality check. If you can produce this stuff, For instance, there's a slide down here on the material agreements that people are going to ask for. You really need to have these agreements done before you can talk about it. So if you've got this fantastic agreement with a key partner, a mere term sheet doesn't suffice, especially a term sheet that's still got red line on it. You'll also, let's say that CTO that is going to be that's really key. He's going to come on board, but you need him to actually be on board before you can talk too much about it. You need to have actually finalized the agreement. We worked with a company a few years ago that was bringing in a CMO, a really, really hot person. They were bringing in almost as a co-founder, somebody that the founding team had worked with in previous companies, had known for 15 years. We're certain they were going to bring him in, but the negotiation process took about 4 months, and getting to transitioning out of the company where he was, and getting an agreement that everybody was happy with. So this is a case where you may need to do some planning, and you may need to do some work to get some things buttoned up before you're ready to go too far.
Right. So I'm just going to page through so everyone can kind of see, but again, I don't know that we have to review it all, but you can see we break down in each of those categories some of the things that you want to be able to put together.
Yeah, another one I'll pull out of here. I think somewhere
Sure.
around, maybe it's corporate records or corporate, whatever we call that slide. A classic is that you may be doing business in 6 different states, but you've never registered in those states to do business, although you're legally required to. Get it done before you start the diligence process. Another typical, you're probably not up to date with your board minutes. You got to get all that tidied up before you get through. You may not have your cap table up to date. You've issued shares, you've issued options, maybe you've issued some convertible notes, never actually entered them into the cap table, even though that happened 6 months ago. Tidy all that up. Those are, I'm not sure I've ever seen a company that was getting ready to raise funding that actually had all that stuff done. It's just really typical that these are the kinds of things that get sort of left by the wayside because you don't have time to do everything in a particular day, and now is the time to do it.
Right. So here's, I was going to say, we were just talking before we started this webinar, and Kevin and I were saying August is a slow month. So this, if it's slow for your business, it may be a good time to start looking through this and gathering together some of this material. I think that takes us to the end of the hour here. We don't have any outstanding questions, but I know the due diligence process is a very personalized process for each individual company. So if you have any follow-up questions or need any help pulling together your projections or anything like that, please feel free to reach out to us or to Kevin. I'm happy to answer your questions. And just a reminder that you are going to receive the deck tomorrow, so you can look through those lists in greater detail and make it into a sort of checklist that you can work off of. We'll also be sending out a link to the recording so you can listen back to this. And a quick plug, our next webinar is August 5th with Ryan Johnson, who's our VP of Operations here at Early Growth Financial Services. And that's going to be a really practical presentation on lean cash flow, simple steps to better cash management. So we hope you'll think about joining us for that one or some of our other upcoming webinars. We have a full calendar out for August and building out our September calendar now. So you can go to our website and click on the events tab to view all of these and to register for any of them. So Kevin, as always, total pleasure working with you. Thank you so much for your insights. And I think that I'm sure the people on the call will find this really useful, and all the investors they're working with will probably thank you as well for preparing all these founders to hand over all the things that will make it an easy due diligence process. So thank you, Kevin.
Great. It was a pleasure. Good luck to everyone with diligence. Good luck with fundraising.
Thanks all. Take care. Bye-bye.